Welcome to the Deep Dive, presented by Knowledge Flow, where we cut through the noise and get straight to the core of what you truly need to know. Today, we're embarking on a comprehensive deep dive into a topic that, whether you realize it or not, touches almost every part of our professional and even personal lives: project management. Now, you might initially think of project management as simply schedules, spreadsheets, and perhaps a lot of meetings. But we're going to unpack its surprising depth, its profound complexities, and its critical human elements that truly make or break any endeavor. Our mission today is to give you, our listener, a real shortcut to being incredibly well informed on this subject, complete with surprising facts and hopefully just enough humor to keep you completely hooked. We'll explore how projects are often like, well, living organisms with their own distinct life cycles, the absolutely crucial role of capital budgeting in deciding what even gets off the ground, and even how navigating the intricate world of managing people can be far, far more complex and challenging than managing any machine or process. So get ready to see project management in a whole new light. Okay, let's unpack this. 1. Foundations of project management, defining the endeavor. So when we talk about project management, what exactly are we talking about? It's far more nuanced than just, getting things done. When you boil it down, it refers to the very specific tools, techniques, and methodologies that skilled managers employ to handle the inevitable complexities and uncertainties that arise in any significant undertaking.
Mm-hmm.
It's about having a systematic, proven approach when you're faced with the unknown, the intricate, or the truly ambitious.
Precisely. In today's fast-paced organizational landscape, project management plays a truly pivotal role. It enables organizations to achieve far better control over their operations, moving beyond mere reactivity to proactive steering.
Right.
And perhaps even more importantly, it fosters stronger, more robust, and more transparent relationships with their customers. The advantages here are not just theoretical, they are tangible and directly impact the bottom line.
How so?
Think about it. Improved control leads to better quality deliverables. Optimized processes lead to lower overall costs due to more efficient resource allocation. And as a direct consequence, you see higher profit margins. It's a clear chain reaction.
And it's absolutely not just about the final outcome, is it? It's fundamentally responsible for handling all those classic management functions we typically talk about. We're talking about meticulously planning out the entire endeavor, organizing all the necessary resources and tasks. Carefully staffing the right people for the right roles, adeptly directing the team members day to day, and continually controlling the progress against the plan. But here's the crucial distinction. All of this is done for a short, defined period to achieve very distinct, often unique project objectives.
Always within constraints.
Always within specific and often very tight constraints like budget or time. It's about proactively dealing with the myriad issues that pop up as a project moves from its initial conceptualization, that first spark of an idea, all the way through to its final, successful completion. It's a journey with a clear endpoint, not just an ongoing process.
At its very core, project management is truly an amalgamation, a sophisticated blend of interrelated activities. What's fascinating here is that these tasks aren't isolated. They don't happen in a vacuum. Instead, they feed into each other, creating a dynamic system. Each activity within the system has clear, well-defined objectives, which are absolutely vital for guiding the work and ensuring everyone knows what they're striving for. All these activities are performed in a specified logical sequence, ensuring a smooth flow from one step to the next without chaos or backtracking. And importantly, they always require deliberate and often incredibly careful resource allocation to ensure efficiency, avoid bottlenecks, and make the most of what's available.
An excellent example that truly illustrates this complex dance might be introducing a brand new product to the market. Think about it. It's clearly a group of activities, each with its own clear-cut objectives.
Right. From R&D.
From initial research and development to meticulous marketing, right through to the grand launch and post-launch support. Project management can even facilitate something as large-scale and impactful as merging global competitors together to work on a single shared project for economic development. Imagine the incredible complexities there.
Yeah, that's huge.
It's truly mind-boggling how many moving parts need to be coordinated.
What's truly fascinating here is that project management typically deals with non-repetitive objectives. Unlike routine, ongoing operations that you see day to day in an organization, Projects are generally unique, one-off ventures, each distinct in its scope and desired outcome. Projects are usually significant, often substantial, investments made for future benefits, designed to yield returns or strategic advantages over time, whether that's financial, market share, or even social impact.
Okay.
And to achieve these unique, future-oriented goals, project management leverages a wide variety of advanced technologies and brings together diverse managerial experts, drawing on a rich tapestry of skill sets and cutting-edge tools to navigate their inherent complexities.
So it's clear that when we use the word project, we're not just talking about any task. Different experts, understandably, define projects in slightly different ways. But what's compelling is how they all converge on some common ground, these core fundamental elements that truly make a project distinct from anything else.
The Institute of Project Management defines it very succinctly and powerfully. A project as a temporary endeavor undertaken to create a unique product or services. This definition really emphasizes two core aspects: its temporary nature.
Right, a beginning and an end.
Exactly. It means it absolutely has a definitive beginning and a definitive end. It's not perpetual. And also its unique output, meaning it's not a repetitive, ongoing process. You're creating something new.
Then there's Meredith and Camuel, who offer another insightful perspective, stating, a project is a specific finite task to be accomplished. Whether it is large or small scale, and whether it is long or short run is not particularly relevant. This definition really drills down on the finiteness, underscoring that the size or the duration of the project isn't the primary defining factor. It's about a distinct, bounded piece of work that has a clear completion point.
UNIDO offers a broader, more socioeconomic perspective that connects projects to a wider societal impact. A project is a proposal for an investment to create and develop certain facilities in order to increase the production of goods and services in a community during a certain period of time.
So linking it to development.
Exactly. This definition really highlights how projects can be vehicles for economic development and community benefit, showcasing their role in fostering growth and improving infrastructure.
William H. Newman keeps it remarkably concise and practical, stating, a project typically has a distinct mission and a clear termination point. This emphasizes that the clear ending is just as fundamentally important as the clear beginning.
Absolutely.
It provides that defined scope and timeline, which are absolutely crucial for accountability and for truly knowing when you're done.
And Davis summarizes it in a way that brings in the crucial element of value. Any undertaking that has definite final objectives representing specified values to be used in the satisfaction of some need or desire.
Value and need.
Right. This definition reinforces that a project isn't just a random set of tasks. It's something that fulfills a real need or desire and delivers tangible, measurable value. If we connect this to the bigger picture, these various definitions collectively underscore that projects, in all their forms, are fundamentally unique, temporary, and purpose-driven initiatives, all geared towards achieving specific, valuable, and often transformational outcomes.
So with these diverse yet converging definitions in mind, what are the defining traits, the core characteristics that truly make a project a project? What delineates it so clearly from routine ongoing operations?
Firstly, and perhaps most fundamentally, clear objectives. A project must have clear, well-defined objectives that are not only ambitious but also absolutely achievable within a specific time frame. Without these, it's truly like trying to navigate a vast ocean. Without a compass or a destination in mind, you'll drift aimlessly and likely never arrive. What's often surprising is how many projects derail, not because of a lack of effort, but because their initial objectives, which seemed clear, were actually vague, contradictory, or constantly shifting.
Scope creep.
Exactly. That lack of clarity up front is a silent killer.
Many projects are also inherently large and complex. This means they typically transcend the capabilities of a single individual, a single department, or even sometimes a single organization.
Yeah, they need diverse teams.
They require various experts from vastly different fields, all coordinating their diverse efforts for unified success. Think about constructing a new, complex hospital wing. You need architects, structural engineers, medical equipment specialists, IT teams, legal experts, environmental consultants, and of course the construction crew.
All working together.
All working in intricate concert. And often, these large projects face the surprising challenge of getting all these disparate experts speaking the same language and understanding each other's priorities.
Absolutely critical are deadlines. Every project has a completion deadline. And these aren't just arbitrary dates plucked from thin air. Delays can incur significant penalties, whether they're direct financial cost, a hit to the organization's reputation, or losing a strategic market advantage.
High stakes.
Very. This imposes a strict discipline, forcing teams to plan meticulously and execute with rigorous efficiency. What's often surprising is that an artificially tight deadline, if managed correctly, can sometimes increase quality by forcing ruthless prioritization and eliminating unnecessary steps,
Interesting.
though it undeniably comes with its own set of intense pressures and risks.
Projects are also generally non-recurring or one-time in nature. This is a fundamental characteristic stemming from their inherent uniqueness. Once a specific new software product is launched or a particular manufacturing facility is built, that exact project isn't repeated in the same form. Even if similar projects might follow down the line, each new iteration or expansion becomes its own distinct project.
In multi-project organizations, where several distinct projects are often running concurrently, there are frequently interdependencies between them. They might share vital resources, exchange critical information, or even influence each other's outcomes.
The ripple effect.
Precisely. The project manager's crucial responsibility here is to skillfully manage these complex interactions, anticipating those ripples and maintaining appropriate collaborative relationships between all the functional groups involved across different projects.
And this interdependency leads directly to resource confliction. The availability of resources, whether we're talking about human talent, financial capital, or material supplies, is almost always limited.
Always.
This scarcity inevitably causes conflicts, not just within multi-project organizations vying for shared assets, but even among team members on a single project who might need access to the same specialized equipment or a particular expert's time. A key, often underappreciated role of project leaders is to skillfully and diplomatically solve these resource allocation problems, acting as a negotiator and a strategist.
Another key characteristic is the presence of a separate, disposable team. A dedicated team is typically assembled specifically to complete the project within its allocated time and cost.
Temporary team.
Right. The crucial part, reflecting the temporary nature of the project itself, is that this team is designed to disband once the project is successfully finished. This can create unique challenges for team building and morale, as people know their tenure is limited.
Finally, much like a human being, every project has a discernible project life cycle. Projects typically start slowly, perhaps in the conceptualization or detailed planning phase, gathering initial momentum. Then they grow, gaining significant traction.
Ramping up.
Resources and intensive activity as execution ramps up. They reach a peak of intensive work, then gradually decline as completion nears and are finally terminated with a handoff of the final product or service. This raises an important question. Expert, how does truly understanding this life cycle influence strategy and management? Does knowing that a decline and termination phase is inevitable change how you plan for resource allocation, team morale, or even knowledge transfer?
That's a great question. Understanding the life cycle is critical because it allows you to anticipate different demands at different stages. For instance, in the growth and peak phases, your focus is on maximizing efficiency and managing intense activity.
Full speed ahead.
Right. But as you move into decline and termination, the focus shifts to demobilizing resources, ensuring proper documentation, and managing team transitions without losing valuable knowledge or skills. A common pitfall is treating the entire project as a continuous linear sprint.
Right, not acknowledging the phases.
Exactly.
Right.
Recognizing the distinct phases helps you apply the right management techniques, allocate resources effectively, and even manage stakeholder expectations at each stage. It avoids burning out your team and losing momentum at the finish line.
Given all these characteristics, the clear objectives, the inherent complexity, the unforgiving deadlines, and that temporary nature, what does the person at the helm, the project manager, actually do? Their job sounds incredibly demanding, a true juggling act.
Their responsibilities are truly vast and multifaceted. They first meticulously identify the availability of people, understanding the human resource pool they can draw from, whether internal or external.
Okay.
Then they are tasked with the immense responsibility of controlling the activities of the project, ensuring everything stays on track. And critically, they are directly responsible for directing the team members in their daily tasks, guiding their efforts. It's a highly challenging job, precisely because of the inherent complexities and uncertainties that are part and parcel of any project.
The orchestrator.
Think of them as the orchestrator of a complex symphony. Exactly.
Indeed. Beyond just directing, They are responsible for expertly coordinating team efforts across different functions, departments, and even organizations, ensuring everyone is aligned and pulling in the same direction. They also need to adeptly satisfy both clients and superiors.
A balancing act.
A delicate balancing act of external demands with internal organizational goals and constraints. It's a continuous negotiation.
A truly effective project manager will also extensively delegate duties and responsibilities to subordinates. This isn't just about offloading tasks, it's crucial for empowerment.
Right.
This empowerment allows those subordinates to concentrate more on their specific tasks, fostering greater efficiency, ownership, and even professional development. Furthermore, project managers often take active participation with board members in negotiations, whether it's for securing additional funding, modifying scope, or resolving major conflict.
Because they know the details.
Exactly. This is because they possess complete, intimate, granular knowledge about the project requirements and its current status, making them indispensable in securing resources or making critical, high-level decisions.
They meticulously observe the progress report of the project, not just glancing at numbers, but actively identifying problems related to progress and potential roadblocks early on. This proactive approach is key.
Spotting trouble early.
Right. Ultimately, the project manager is singularly responsible for the successful execution of the plan. What stands out to you about the sheer breadth and depth of this role? It's far more than just a taskmaster, wouldn't you say?
Oh, absolutely.
It sounds like someone who needs to be a strategist, a diplomat, a motivator, and a problem solver all rolled into one.
Absolutely. What truly stands out is the sheer blend of hard and soft skills required. You need to be analytical and detail-oriented to track progress and manage budgets, but equally, you need to be an exceptional communicator, negotiator, and leader.
The people skill.
Exactly. It's not enough to know what needs to be done. You have to inspire and enable a diverse group of people to do it, often under pressure. A great project manager isn't just about execution. They're about navigating human dynamics and unforeseen challenges with grace and strategic foresight. 2. The project's journey. From concept to financial viability.
Before a project even gets off the ground, before any shovels hit the dirt or any code is written, a firm has to make crucial, often enormous, decisions about where to invest its funds for long-term benefits. This strategic process, this commitment of significant resources upfront for future returns, is known as capital budgeting.
Indeed. And these investment decisions must be made with extreme, almost obsessive care, because once they are made, they are notoriously difficult and incredibly costly to reverse.
Hard to undo.
Very. Pulling back after a major capital commitment can be financially ruinous and disrupt the entire organization. Capital budgeting can be systematically divided into 5 distinct phases. And while there's a main logical sequence to them, it's vital to understand that there are also interactive loops. Yeah. Meaning phases can and often should influence each other, allowing for flexibility, reevaluation, and adaptation as new information emerges. It's not strictly linear.
Let's truly dive into these 5 phases: planning, analysis, selection, implementation, and review. The planning phase is where it all begins. This is all about generating initial ideas that align with the organization's strategic goals and then securing the initial funds needed to even explore those ideas.
The seed funding, sort of?
Exactly. It provides the essential framework for identifying opportunities. After an opportunity is identified, there's an immediate critical need to analyze it thoroughly and check its feasibility from various angles before committing further.
Moving into the analysis phase, this is where we truly dive deeper and get granular. Here we meticulously analyze various critical aspects of the project. This includes its marketing viability. Is there a market for this?
Key question.
Its technical capabilities, can we actually build it? Its environmental impact, what are the ecological considerations? Its broader economic considerations, how does it fit into the wider economy? And of course, its comprehensive financial implications, will it make money?
Bottom line.
The main focus of this phase is diligently collecting, summarizing, and then rigorously analyzing all project-related data and information gathered across different project proposals. This is where the raw data starts to tell a comprehensive story about the project's real potential and its inherent risks.
Next, we arrive at the selection phase. In this stage, the focus shifts to whether the project, having passed the rigorous analysis phase, is truly reliable and financially feasible.
Go or no go?
Pretty much. If it's found to be sound and promising in the analysis phase, it's then selected for further development and resource allocation. The selection process itself uses different methodologies, broadly categorized into 2 types. First, non-discounting methods.
Simpler ones.
Right. which are simpler and include the payback period, which asks, how quickly will I recover my initial investment, and the accounting rate of return, a straightforward percentage. And then there are the discounting methods,
More sophisticated.
which are far more sophisticated because they crucially consider the time value of money, recognizing that a dollar today is worth more than a dollar tomorrow. These involve metrics like net present value, or NPV, which essentially asks, if I invest in this project, what's the future profit worth to me today after accounting for inflation and interest? Then there's the internal rate of return, or IRR, which is like calculating the effective interest rate your project is expected to earn. And finally, the benefit cost ratio, which compares the total benefits to the total costs.
So a richer financial picture.
Exactly. These methods provide a much more nuanced and accurate financial evaluation.
Following successful selection, we enter the implementation phase. This is where the rubber meets the road. It's a very important and often the most time-consuming phase, as it's where the project truly moves from concept to tangible reality.
Making it happen.
Precisely. This includes critical stages like the detailed designing and the actual construction of manufacturing facilities, or the intricate development of the product itself. For truly effective implementation, especially at a lower cost, there are 3 key steps. First, the appropriate, precise formulation of the project from the outset, getting the plan right.
Foundational.
Second, clear, unambiguous assignment of responsibilities to ensure accountability and avoid confusion. And third, the strategic use of network techniques, which we'll delve into in more detail later, to optimize schedules and manage the flow of resources efficiently.
Finally, we reach the review phase. This critical phase doesn't just happen at the end. It takes place periodically after selection and implementation to constantly measure the project's performance.
Ongoing checks.
Yes. Performance review is absolutely essential for comparing actual performance against the desired performance on an ongoing basis, providing vital, real-time feedback. This continuous comparison helps in suggesting immediate corrective actions for any deviations and, importantly, informs and improves future project planning by capturing lessons learned.
If we connect this to the bigger picture, you can clearly see how this structured, disciplined approach to capital budgeting helps mitigate the significant, often irreversible risk associated with major investment decisions. It's a comprehensive, systematic framework specifically designed to increase the likelihood of long-term success by forcing rigorous thought and multiple checkpoints before, during, and after a project's life.
Once we're seriously thinking about a project and we've considered the capital commitment, the very first question after assessing overall feasibility is always, is there a market for this? Is there a genuine demand for what we plan to create or offer? This is precisely where comprehensive market and demand analysis comes in. It's foundational.
This is arguably the most important factor in the entire project analysis for project formulation. It's the foundational step that determines the potential size of the market for the product or service we intend to offer, and crucially, the actual demand that exists or can realistically be generated for it.
Because without demand...
Exactly. Without a viable market and sufficient demand, even the most brilliantly executed project, technically and financially, is destined to fail. It's the ultimate reality check.
There are a few key steps here that are absolutely essential to conduct this analysis effectively. The first is situational analysis. This helps us quickly understand the fundamental relationship between the proposed product or service and its potential market landscape.
Getting the lay of the land.
Precisely. It's about getting a preliminary, high-level grasp of the competitive environment, customer needs, and overall trends. If enough adequate data is generated during this initial analysis to accurately measure the market's potential, a formal, incredibly in-depth study might not even be needed.
Which saves time.
Which can save a significant amount of time and resources.
Following that, we move to gathering secondary data. Information for market analysis can, of course, come from primary and secondary sources. Secondary information is data that is already available and has been collected for other purposes from various sources.
Existing info.
Right. This provides a crucial base and an excellent starting point for any market and demand analysis, as it can quickly paint a broad picture of the industry and customer trends. Sources of secondary information are quite diverse. You can find valuable insights from government census reports, various national planning documents, economic surveys.
Lots of sources.
Industry-specific reports from central banks or trade associations, publications of advertising agencies, and even techno-economic surveys. The key isn't memorizing every single source, but understanding that a wealth of data already exists and knowing how to strategically tap into it to quickly validate your initial market assumptions.
While secondary data is foundational, conducting a market survey to gather primary information is also vital for comprehensive, up-to-date insights specific to your project. Primary information is data collected directly from market surveys,
Fresh data.
tailored precisely to your specific needs and questions. While a census survey, which attempts to cover every single potential customer, can be incredibly expensive and often infeasible for most projects, a sample survey is mostly used. This involves surveying a carefully selected, representative portion of the target market to extrapolate broader trends.
Okay.
The steps for a successful sample survey are systematic. First, precisely define your target market. Then, select an appropriate sample size that is statistically representative. Next, develop a clear, unbiased, and effective questionnaire. After that, recruit and train field investigators to collect the data ethically and accurately.
Proper training is key there.
Absolutely.
Yeah.
Then, you get the information from the field. After collection, you must rigorously examine that information for completeness and accuracy, cleaning any errors, and finally, you analyze that information to draw meaningful, actionable conclusions.
Once all this primary and secondary information is gathered and meticulously analyzed, the market can then be accurately characterized. This involves understanding various interconnected aspects: the effective demand for product services, both in the past and present, to see trends.
Historical and current demand.
Right. How that demand can be broken into different segments based on customer needs, demographics, or behaviors. The potential for price differentiation across these segments. Can you charge different prices to different groups?
Huh?
Effective distribution and sales promotion techniques. How will you get your product to customers and tell them about it? A deep demographic, sociological, and attitudinal characterization of your target consumers. Who are they? What do they value? And how do they think?
Knowing your customer.
Deeply. A thorough analysis of the existing competition and the current supply within the market. Who are you up against? And finally, understanding the impact of relevant government policies on the market, as regulations can significantly influence viability.
Building on that characterization, demand forecasting is the forward-looking estimation of future demand. It's not just a prediction, it's a strategic necessity that underpins almost everything else.
You need that forecast.
Business planning essentially starts with this crucial step, as everything from production schedules to financial projections hinges on anticipating future customer needs. It directly influences production planning, how much to produce.
Investment planning.
Fund investment planning, how much capital to allocate based on expected sales.
Yeah.
And obtaining raw material planning, what supplies are needed, and when to avoid costly shortages or excesses.
Demand forecasting happens at 4 distinct levels, each providing a different scope and granularity of insight. There's forecasting at the company level, which focuses on specific products or services a single company offers. Then there's the industry level, which looks at the broader sector, perhaps all manufacturers of a certain type of product. Beyond that, the national level assesses demand across the entire country, considering macroeconomic factors. And finally, the international level, which considers global trends, trade policies, and demand in various world markets.
So, micro to macro.
Precisely. This multi-level approach provides a comprehensive view.
The final, crucial step in this comprehensive market analysis is market planning. An effective market plan needs to skillfully integrate all these factors we've discussed, including astute pricing strategies, efficient supply chain considerations, creative promotion methods to capture attention, and robust distribution channels to ensure accessibility.
Bringing it all together.
Exactly. The ultimate goal here is to ensure that products can easily reach consumers, that the messaging resonates, and that the project achieves its desired level of market penetration, truly turning that forecasted demand into actual sales. Here's where it truly gets interesting. It's that fascinating blend of hard statistical analysis, deep qualitative research, and the art of strategic planning needed just to understand if there's a truly viable place for your product in the world.
Data meets strategy.
It's a compelling combination of data science and creative foresight. Once we've established there's a definite viable market for our product or service, the next big question that logically follows is, can we actually build this thing? Can we produce it, deliver it at scale, and sustain it in the long run?
Yeah, the feasibility question.
That's precisely where technical analysis comes in, moving from the want to the can we.
Technical analysis is incredibly important for robust project appraisal, especially because project decisions are often highly complex, involve significant long-term investments, and are inherently difficult to undo once committed.
Like capital budget decisions.
Yeah, exactly. For a project to be truly successful, various technologies, processes, and logistical arrangements are needed. And crucially, they are only pertinent, meaning suitable and valuable, if found relevant, acceptable, and feasible within the operational context. It's about ensuring what we want to do can actually be done efficiently, effectively, and sustainably.
So, expert, what are the crucial issues that technical analysis rigorously delves into? What are the practical nuts and bolts that need to be examined?
Firstly, we examine the material required. This defines all the input materials, both raw and processed, necessary for the project's operations. There's a very close, almost interdependent relationship between the study of material requirements and other aspects like the ultimate choice of technology, the ideal location for the project facility, and the specific machinery needed.
They all connect.
Absolutely. A change in material availability, for example, could ripple through all these other areas.
Then there's site and location. This is a particularly crucial aspect of technical analysis, intrinsically linked to assessing market demand, the ultimate size of the market you're serving, and your raw material requirements. It's about finding the optimal physical place for your project.
Location, location, location.
Indeed. Location refers to a broader area, like a specific city, region, or industrial zone, while site refers to the specific piece of land within that broader location where the project facilities will be set up. Factors influencing this choice are numerous, complex, and critical. Relevant government policies and regulations.
Proximity to suppliers.
The critical nearness to both raw material suppliers and key markets for distribution. The accessibility of vital infrastructure like roads, reliable power, and clean water. Careful considerations for environmental pollution and its potential mitigation.
Climate, labor.
Prevailing climatic conditions which can impact operations, and importantly, the labor situations. The availability, skill level, and cost of skilled, semi-skilled, and unskilled labor in that area. A suboptimal location can cripple a project from day one.
Next is the capability of plant, which refers directly to the production capacity, meaning the maximum number of units that can be produced during a given period. The fundamental goal here is not just to build a massive plant, but to build one with a capacity that can be fully utilized to meet anticipated demand.
Right-sizing it.
Exactly. Rather than simply going for an excessively large capacity in the speculative desire of future, uncertain growth. Overcapacity can be a significant drain on resources and lead to unnecessary fixed costs. Factors affecting plant capacity decisions include input constraints, such as raw material availability or energy supply, technological requirements that dictate the minimum or maximum production scale, the overall investment cost associated with different capacities, relevant government policies which may impose limits or provide incentives,
Market conditions, too.
market conditions, current and projected, which guide expected demand, and the consistent availability of resources like power and water.
Another critical area, often involving complex trade-offs, is the production process and technology. Selecting the very best production process and its related technology is a profoundly crucial decision for the long-term success of any project.
Foundational choice.
It really is. Often a specific product can be made using various alternative materials and a multitude of technologies, each with its own advantages and disadvantages. Therefore, choosing the most suitable one is vital because it directly impacts the optimal plant size, the efficiency of operations, and the overall project cost.
Big impact on cost.
Huge. It's a foundational decision that cascades throughout the entire project's lifecycle. Factors influencing these technological decisions include the ease of absorption or seamless integration of the technology into existing operations or the team's skill set, the initial investment and ongoing production costs associated with it.
Plant capacity fit.
Its compatibility with the desired plant capacity, whether it incorporates the latest, most efficient developments in the field, and even its proven successful use by other units in the industry. You don't always want to be the first adopter.
Following that, we determine the machinery and equipment requirement. This naturally depends directly on the chosen production technology, the specific type of project, for example, manufacturing, service, or development, and the determined plant capacity.
What tools you need.
Exactly. In manufacturing, the choice here is often quite broad because many different machines can perform similar functions, requiring careful selection to optimize for efficiency, cost-effectiveness, and reliability. This isn't just about buying new, it's about selecting the right tools for the job.
We also carefully look at the product mix. This depends heavily on anticipated market demand and strategic business goals. Companies typically aim to enhance their overall profit and market share by providing variation in quality, features, and quantity within their product offerings.
Variety for the market.
Right. It's important that flexibility in product mix should be maintained when planning production facilities, allowing for crucial adaptation to changing market tastes, emerging competitive pressures, or new regulatory requirements. Sticking rigidly to one product can be a recipe for obsolescence.
Then there's the meticulous scheduling of work. This refers to the detailed planning of work with respect to both the installation of facilities and the initial operations once production begins. This work scheduling is absolutely necessary to proactively forecast potential problems that might arise in the production and development of the product.
Anticipating issues.
It must be designed very carefully to avoid significant losses that can result from idle capacity, expensive equipment sitting unused, or the wastage of valuable raw materials due to uncoordinated processes.
Finally, charts and layouts. These are critical visual tools that define the precise scope of the project and also provide a fundamental basis for accurately estimating both the initial investment cost and the ongoing production cost.
The blueprint.
Exactly. Project charts and detailed layouts may be developed only after comprehensive data on plant capacity, the chosen production technology, specific machines or equipment, and the overall market size are readily available and thoroughly analyzed. They serve as blueprints, guiding every subsequent step.
This truly raises an important question. Host, how interconnected are all these technical aspects, and how does a shift, even a seemingly minor one, in one area, say, a sudden change in material availability, a breakthrough in technology, or an unexpected government policy ripple through and impact all the others?
Yeah, domino effect.
From your chosen location to your detailed scheduling, it really highlights the holistic, interconnected nature of technical analysis.
That's a great point. It's like a giant, intricately balanced mobile. Push one piece and the whole thing shifts. If your preferred raw material becomes scarce, you might have to pivot to a new technology,
Which changes capacity needs.
which could then change your ideal plant capacity, potentially forcing you to reconsider your location entirely due to different infrastructure needs. Or a new environmental regulation might mean you need different, more expensive machinery, which impacts your financial analysis.
Everything's connected.
Every decision has a cascade of consequences, making the initial technical analysis absolutely vital for long-term viability. It's a dynamic puzzle that project managers are constantly trying to optimize. 3. Project economics and control, making it profitable and keeping it on track. So we've established there's a market for our product or service, and we understand the technical feasibility of building it. We know what to make and how to make it. But now comes perhaps the most critical question for any business venture. Can we afford it, and will it actually make money?
The big question.
This is where rigorous financial analysis becomes absolutely paramount, moving from dreams to dollars and cents.
You're spot on. Financial analysis isn't just a desirable step. It's absolutely necessary for a project's success. It requires a meticulous, almost forensic examination of various aspects of the project, all from a stringent financial point of view.
Not just optional.
Not at all. This isn't just about crunching numbers for the sake of it. It's about assessing the project's overall economic viability, its sustainability over the long term, and its potential to generate the desired returns. It's the hard truth about whether the project can stand on its own two financial feet.
What are these various crucial financial aspects we need to delve into? What are the key elements that contribute to the project's overall financial picture?
First, we meticulously calculate the project cost. This is a key financial requirement, representing the total of all outflow items related to a project that are supported by long-term funds. Essentially, it's the total investment needed to get the project fully operational.
The total price tag.
Exactly. Some important aspects that comprise this total project cost include the margin money for working capital, which is the operational cash needed for day-to-day running, any expenses on foreign technicians if specialized skills are brought in from abroad, the critical cost of developing the land and site,
Land prep.
including grading, utilities and access, technical knowledge and engineering fees for design and expert consultation, the actual construction of buildings and facilities, crucial provisions for eventualities or unforeseen circumstances.
Contingency funds.
Precisely, because things rarely go perfectly to plan. And finally, the initial operative expenses incurred before revenue streams stabilize and the project becomes self-sustaining.
Then there's the ongoing working capital requirement and its financing. Working capital is the short-term fund needed for day-to-day operations, the grease in the gears, if you will.
Keeping things running.
Right. It's continuously required for purposes such as purchasing raw materials, funding the stock of work in process, those partially completed goods on the assembly line, covering daily operating expenses like wages and utilities, and maintaining a healthy stock of finished goods before they are sold and generate revenue.
And financing that.
As for its financing, common accessible sources include trade credit from suppliers, where you pay for goods later, and short-term advances or credit lines provided by commercial banks.
The means of financing the overall project are also absolutely critical. The requirement for substantial financial resources is a very crucial factor for successfully managing and developing any project, especially large ones.
Where the money comes from.
Exactly. There are various means of finance available for project formulation and completion, each with its own terms, implications, and risk profiles. These include securing a term loan from banks or other financial institutions, which is typically a longer-term debt. Raising capital through share capital by issuing equity, essentially selling ownership stakes in the company. Various miscellaneous sources that might be unique to the project. Issuing debentures, which are essentially bonds or long-term debt instruments, and securing deferred credit, where payment for goods or services is delayed, often by agreement with suppliers. Choosing the right mix of these is a strategic decision itself.
We also need to meticulously calculate the production cost. This cost arises from the various aspects of the project that are directly required for ongoing production and operations once the facility is built or the service is running.
The running costs.
Exactly. The various components of production costs typically include the direct labor costs for employees involved in production, the material costs for all raw inputs and components, factory overheads, which are indirect manufacturing costs, like rent, depreciation, and utilities themselves, such as electricity, water, and fuel directly consumed in the production process.
The preparation of projected cash flows is vital to truly understand the firm's anticipated project cash balances over time. A cash flow statement is a dynamic financial document that meticulously shows the movement of cash, both in and out of the firm.
Cash in, cash out.
And its net impact on the cash balance over specific periods, like months or quarters. It provides a clear, essential picture of liquidity, showing whether you'll have enough cash on hand to pay your bills and fund operations.
Along with cash flows, the estimation of production and sales is absolutely necessary for accurately forecasting profit, which fundamentally depends on the forecasting of sales revenue.
Predicting revenue.
Right. Sales revenue forecasting, in turn, depends on various interconnected aspects, such as the chosen selling price for the product or service, accounting for potential low utilization of capacity in the initial year as the project scales up and gains market traction, and necessary adjustments for opening and closing stocks of finished goods, ensuring you're not over or underproducing.
The balance sheet provides a comprehensive snapshot. It shows the financial position of the firm at a given point in time, typically at the end of a reporting period, detailing various assets and liabilities.
Assets and liabilities.
On the liability side, you'll find items such as reserves and surplus, retained earnings, share capital equity, current liabilities, short-term debts, and long-term loans. On the asset side, you'll find fixed assets, property, plant, equipment, investments, current assets, cash, inventory, receivables, and any miscellaneous expenses and losses that need to be accounted for. It's like a financial photograph.
And finally, a very important metric, particularly for understanding viability, is the break-even point. This refers to the critical point where the company experiences no profit and no loss.
The tipping point.
Exactly. It's a critical calculation, performed to determine the precise capacity level at which the project becomes profitable, allowing managers to understand the absolute minimum operational scale needed for financial viability. Conversely, it also helps identify what level of operations should be avoided to prevent incurring losses.
How is it calculated?
It's calculated based on the project's fixed costs, those that don't change with production volume, like rent, and variable costs, those that do change, like raw materials. Understanding this point is key to setting realistic sales targets. So what does this all mean for you, our listener? It's about ensuring the project is not just technically feasible and market viable, but also financially sound, sustainable over its life cycle, and ultimately capable of generating the desired returns. It's the ultimate financial reality check that transforms a good idea into a genuinely profitable venture.
Where vision meets the ledger.
Exactly, is where the vision meets the ledger. With the financial aspects meticulously laid out and thoroughly understood, the next equally critical challenge isn't just making the plan, but actually sticking to it, especially when projects inevitably hit snags. How do we ensure the project stays on course, hits its targets, and delivers on its promises amidst real-world chaos?
Yeah, keeping it on track.
This brings us to the dual interconnected functions of planning and control. They're like two sides of the same coin.
Planning is arguably the most important part of the entire project management process. Before starting any significant undertaking, every single aspect of the project must be planned effectively, meticulously, and with foresight.
Planning is everything.
Well, nearly everything. This is especially crucial because projects are inherently investments for future benefits, and robust planning is the primary mechanism for mitigating the risks to those future returns. Planning encompasses everything: anticipating and strategically allocating limited resources, identifying and securing the required technologies, estimating and managing the most valuable asset, human resources,
People.
and meticulously outlining all the processes or activities involved down to the granular level.
Planning has several vital functions that truly underpin a project's success and make it more than just a theoretical exercise. First, it provides a clear base for working on the project itself and for assigning responsibilities to individuals and teams,
Clarity of roles.
ensuring everyone knows their precise role and what's suspected. Second, and crucially, it's the very foundation for effective monitoring and control, allowing you to track progress accurately against a clearly defined baseline. Third, planning also provides coordination and clear communication, fostering essential synergy between the project and its personnel across different functions.
Communication is key.
Fourth, the integrity of both financial analysis and technical analysis of a project also depend heavily on effective planning, as accurate estimates and assessments are built upon well-defined, realistic plans. And finally, planning always takes place after the project's overarching objectives and strategic policies have been clearly decided, ensuring alignment with the organization's broader strategic goals.
There are also various distinct features that define good comprehensive planning. There's the planning of financial aspect. Given that large amounts of money are spent on implementing a project, an appropriate, transparent accounting structure is crucial to ensure that all expenses are incurred within the budget limits and tracked diligently.
Keeping costs in check.
Then we have the planning of project work. The working activities of the project must be defined clearly, concisely, and all activities should be properly sequenced for smooth execution, avoiding bottlenecks, rework, and wasted time. Next is the planning of information system. An effective and proper information system should be planned from the outset to facilitate the seamless, timely exchange of ideas and all required information among team members and stakeholders,
Good info flow.
fostering transparency and quick decision-making. And finally, the planning of human resource. Human resources are a crucial, if not the most crucial, aspect for the successful development of any project. Their exact estimation and the clear assignment of their responsibilities are absolutely paramount to project success, ensuring you have the right people in the right role.
Right skills, right place.
Exactly. What's fascinating here is how planning is not a separate, isolated step that you complete and then move on. It's an interwoven, continuous element that dictates success across all facets of project management, from managing finances to empowering personnel.
Once planned, how do we keep it on track? How do we ensure that meticulously crafted plan actually translates into reality, especially when the unexpected inevitably happens? This is where project control comes in as the absolutely essential guiding hand of project management.
Project control involves constantly and systematically comparing actual performance with the desired performance or the planned trajectory of the project. If there's a deviation, if what's happening isn't what was planned, it must be noted immediately, analyzed properly to understand its root cause.
Find the why.
And then swift, decisive corrective actions must be taken. The project manager must always be alert, vigilant, and proactive for such changes, as early intervention can prevent minor issues from snowballing into major, costly crises. It's like having a highly sensitive dashboard and an agile steering wheel.
Project control has two main objectives that truly drive its importance and value. First, it powerfully motivates project personnel towards achieving the defined project objectives by providing clear targets, regular feedback, and a sense of shared purpose.
Motivation through clarity.
And second, it assures the regular, consistent monitoring of performance, providing continuous oversight, accountability, and the ability to adapt.
Key tools for effective project control often include highly visual aids that simplify complex information, making it accessible at a glance. The Gantt chart, for instance, is invaluable.
The Gantt chart.
Imagine a simple bar chart where each bar is a task on your project's to-do list, and its length tells you how long it's expected to take. It helps the project manager know precisely which activities should be performed at a given time and allows them to monitor the regular progress of the project, enabling quick identification of issues and prompt corrective action.
Visual progress tracking.
Right. Another powerful technique is the line of balance. This helps you compare the actual level of completion of each process stage with its expected level at any given time, providing a clear visual representation of where the project stands against its schedule, helping to spot bottlenecks or areas falling behind.
Spotting those bottlenecks early. Simple yet incredibly powerful visual tools that are indispensable for keeping a complex project moving forward, ensuring it remains aligned with its objectives, and ultimately hitting that finish line successfully. 4. Advanced techniques and the indispensable human element. Now, to handle truly complex projects, where hundreds or even thousands of interconnected tasks need to be managed simultaneously, managers often turn to more sophisticated analytical tools known as network techniques.
Right, going beyond the basic charts.
These aren't just simple timelines. They map out the intricate relationships, dependencies, and potential bottlenecks between every single task in a project.
You've hit on a critical point. Networks refer to network flow diagrams, which visually represent the interrelationship between various project activities. These activities are interlinked with each other in various ways, showing dependencies and sequences.
Like, this needs to happen before that.
Exactly. You can't pour the foundation until you've dug the trenches. A network flow diagram is typically a graph which uses small nodes connected with arrows to represent these relationships and the flow of work. Based on the time duration of each activity, two main widely used network techniques can be deployed: the critical path method, or CPM, and the program evaluation and review technique, famously known as PEERT.
Let's start with the critical path method, CPM. CPM is an incredibly important technique in production planning and scheduling. It's remarkably versatile and can be applied at one extreme for very simple jobs, like organizing a small team event. And at the other extreme for the most complex jobs imaginable, such as managing the construction of a skyscraper, developing a new aircraft, or even launching a space mission. Its power lies in its scalability and logical rigor.
CPM specifically identifies the route or sequence of activities that requires the greatest normal time to achieve. In essence, it's the single longest path through the network of tasks from start to finish.
The longest chain.
Exactly. And this path crucially determines the shortest possible total project duration. What's critical here is that any delay on activities along this critical path will directly, immediately, and proportionally delay the entire project.
No wiggle room on that path.
None. This makes it your absolute focus for management and risk mitigation.
The steps to implement CPM are quite systematic, almost like a detailed recipe for success. First, you divide the project into various discrete activities. Then you mark all activities and ensure you are ordering them in a logical sequence.
Getting the dependencies right.
Understanding which tasks must absolutely precede others and which can happen concurrently. Next, you draw an arrow diagram to visually represent these activities and their dependencies. It's a powerful visual map. You then need to provide a unique number to all the activities and nodes for clear identification.
Then the time estimates.
The crucial step follows. You find out the time for each activity, how long each task is expected to take, usually a single firm estimate. You then put these activity times on the arrow diagram. From there, you compute early and late start and finish times for each activity, which helps identify flexibility and slack time.
So slack time is key.
Very. You then organize these various times in a tabular form and mark the early start time, EST, and late finish time, LFT, on the arrow diagram. Following this, you find out the total float for each activity, which is the amount of time an activity can be delayed without delaying the overall project. Finally, you recognize the critical activities, those with zero float, meaning no wiggle room.
The ones that matter most for time.
And label the critical path on the arrow diagram, which is the sequence of these critical activities. And from all this meticulous work, you can precisely compute the total project duration.
And here's where it truly gets interesting for strategic managers. To intentionally reduce the total project duration, if needed for market advantage or to avoid penalties, one can strategically crash the critical activities of the network. Crashing.
Yeah, meaning investing more resources, like additional labor or overtime, to speed them up. You then optimize the cost of this crashing to ensure that speeding up doesn't become prohibitively expensive or counterproductive.
Balancing speed and cost.
Exactly. Identifying that one sequence of tasks that dictates the entire project timeline gives you an incredibly clear focus for resource allocation, risk management, and strategic interventions. It's about knowing where to apply pressure for maximum impact.
Now let's turn to the program evaluation and review technique, PERT. PERT is fundamentally different from CPM because it's specifically designed for situations where there's significant uncertainty about time durations for activities.
Right, when you don't know the exact time.
Which is common in novel or research-oriented projects. Correct. While CPM thrives on deterministic time estimates, PERT embraces variability. The PERT technique, as a method, is applied when precise time durations are difficult to ascertain. It's a time-event network analysis method which involves the application of network theory for scheduling problems, particularly for complex, non-repetitive, and often innovative projects where exact time estimates are difficult to pin down upfront.
There are specific reasons for PERT's unique requirements, making it distinct from CPM in its approach. First, every individual task should be clearly shown in a network diagram, providing a comprehensive visual representation of the entire scope.
Visual clarity.
Second, every circle in the diagram shows an event, representing a specific accomplishment or milestone, whose completion can be calculated at a given time. And third, every arrow shows the activity that is the time-consuming element of the program, representing the efforts that must be made between events to move the project forward.
A key differentiator for PERT, and what makes it so powerful for uncertain projects, is its ability to evaluate 3 different time estimates for each activity. This helps manage that inherent uncertainty in novel projects far more realistically.
3 times.
Yes. You have the most likely time, which is the most frequent time an activity is expected to take under normal conditions, the time it would most often be completed. Then there's the optimistic time, which is the completion time an activity would take under ideal or best-case conditions.
Best case scenario.
Assuming no unforeseen problems, a truly perfect scenario. And finally, the pessimistic time, which is the completion time an activity would take in adverse or worst-case conditions, assuming significant difficulties or unexpected challenges.
Worst case.
By considering these 3, PERT creates a more realistic probability distribution for task completion.
The steps for PERT are also systematic, building on some of the principles we saw in CPM. You begin by systematically dividing the project into various activities. Then you sequence the order of events and activities logically. Next, you draw the network diagram, similar to CPM. You then mark all events and activities clearly. Numbering should be given to every event, starting with 1, from left to right in the order they occur. Dummy activities, which represent dependencies but consume no time, are represented by dotted arrows. You must ensure every activity has only one location within the network to avoid ambiguity.
Then the calculations.
Crucially, you calculate the 3 time estimates, optimistic, most likely, and pessimistic, for each activity by using specific formulas. From these, you calculate the standard deviation and variance of each activity, which quantifies the inherent uncertainty. Then you find out the critical path, similar to CPM, but now considering the probabilistic nature of the times.
Probability comes in.
Exactly. And finally, you compute the probability of completion of the project by a specific target date, offering a statistical confidence level that is incredibly valuable for strategic planning and managing stakeholder expectations.
If we connect this to the bigger picture, PERT's ability to robustly handle uncertainty compared to CPM's more deterministic approach makes it invaluable for novel, complex, or research-heavy projects where precise time estimates are initially difficult to ascertain.
Right, for the unknowns.
Think of it this way. CPM gives you the best-case scenario racetrack if everything goes perfectly. PERT, though, tells you, given the inevitable weather changes, potential tire blowouts, and unexpected traffic, here's our most likely arrival time, and here's the onlyest and latest we could possibly get there. It provides a far more realistic and statistically informed view of project timelines under conditions of real-world variability.
Which is most projects.
Which is the norm, not the exception.
Once the project is underway and leveraging these sophisticated network techniques like CPM and PERT, how do we ensure it's truly effective and course-correct when needed? How do we maintain that absolutely crucial feedback loop, ensuring we learn and adapt?
The review process.
Through rigorous, continuous project review.
Project review is an absolutely critical, ongoing part of project management. It helps to control the project effectively and is essential for initiating immediate corrective actions if there are any gaps, deviations, or unexpected issues from the planned trajectory.
Checking in regularly.
Yes, project managers are tasked with developing detailed action plans for the project and then reviewing its entire performance from time to time, regularly checking progress against benchmarks. Importantly, once the project is implemented and even completed, data from various events and stages are meticulously collected and evaluated.
Post-project review, too.
Absolutely. This evaluation is not just for the current project. It helps significantly in planning new projects for future purposes, creating a valuable organizational learning cycle that captures best practices and avoids past mistakes. It's how organizations get smarter.
So, expert, what's the specific need and tangible importance of this ongoing review process? It's clearly not just a formality. This sounds like a cornerstone of success.
Firstly, it helps to persuade top management that satisfactory progress is being made. This is vital because top management regularly reviews project reports about progress and status.
Keeping leadership informed?
And engaged. Their informed review helps them suggest solutions for problems occurring during project execution, keeping them not just informed, but actively engaged and supportive, which is invaluable.
Secondly, it profoundly enhances efficiency and understanding among team members. Regular, structured project reviews eliminate communication gaps and help resolve conflicts that inevitably arise between team members or departments,
Clearing the air.
often through open, honest discussions in regular meetings. This fosters a more cohesive, collaborative, and ultimately more efficient working environment for the accomplishment of desired goals. It builds team trust.
Thirdly, it critically keeps everyone on the project in touch. Project review provides a proper, continuous flow of communication and information to all members, from the newest hire to the most senior manager.
Everyone on the same page.
Exactly. This continuous exchange is absolutely crucial for facing and overcoming the myriad uncertainties that inevitably arise in any project, ensuring everyone has the most up-to-date information to make decisions.
And crucially, it helps us know better the effectiveness of the project itself. Project review measures the overall effectiveness of the project, meaning it assesses whether the project is progressive or stagnant.
Is it working well?
Right. It estimates the productivity of the project, whether it's going smoothly, efficiently, or encountering persistent hurdles. Ultimately, it significantly improves the overall effectiveness of the project by continuously reviewing and controlling its performance, leading to sustained improvement.
The main aspects of project review include starting the review process early and consistently, a thorough analysis of the capital budgeting decisions made to ensure they are still sound, a detailed performance analysis throughout the project lifecycle, and a vital post-review after completion to capture final lessons.
A whole life cycle.
This continuous feedback loop is truly vital for success, allowing for adaptation, learning, and refinement at every single stage of the project's journey.
We've talked about processes, finances, and sophisticated technologies, all the technical mechanics of project management. But who actually does all of this? Who brings the plans to life, manipulates the tools, and delivers the results?
The people.
The people. It always comes back to the human element.
Humans are undeniably the single most important aspect of project management. They are the ones responsible for effective planning, the nuanced project formulation, the diligent execution, the successful completion of tasks, and ultimately for goal achievement.
Can't do it without them.
Not at all. An effective, empathetic, and coordinated human relations system is absolutely required for successful implementation. It's a core truth that the success or failure of a project truly depends on effective human resources, on people with the right skills, knowledge, and collaborative spirit working together as a cohesive, motivated team. What's truly surprising is how often organizations spend millions on technology and processes, yet overlook the fundamental importance of truly understanding and nurturing their human capital within projects.
And it's worth noting a critical distinction here that really emphasizes this point. While financial and technical problems can often be solved, at least theoretically, with additional investment.
Throwing money at it.
Right, by throwing more money at the problem or by adopting new, better technologies. Problems related to manpower issues of morale, communication breakdowns, skill gaps, or motivation are significantly more difficult to solve, especially in the short, temporary period of a project's life.
People problems are harder.
Much harder.
Yeah.
You can't just throw money at a morale issue or a fundamental skill gap and expect an immediate fix. It takes time, empathy, and strategic intervention.
Given this undeniable reality, the project manager often acts as a critical driver in this context. This acronym perfectly encapsulates their human-centric role, highlighting the soft skills that are so often overlooked but are absolutely vital.
Driver.
Yes, they direct the individual and team, providing clear guidance and setting expectations. They reinforce commitments, ensuring everyone understands and stays aligned with the project's goals even when challenges arise. They inform everyone, facilitating a transparent, timely flow of communication up, down, and across the team.
E-form. Vitalize.
They are vital in vitalizing teamwork, actively fostering collaboration, resolving conflicts, and building morale. They empower team members by thoughtfully delegating authority and trusting their abilities to take ownership. And finally, they are crucial in risk handling.
Risk. Driver.
Got it. Addressing not just technical and financial risks, but also the often unpredictable human-related risks like burnout, conflict, or lack of engagement.
So given that comprehensive driver role, what are some of the key challenges project managers most frequently face in achieving genuinely good human relations for project success, especially when human problems are so much harder to fix quickly?
A significant and constant challenge is motivating the people. Project managers must ensure every single person on the project feels that they are executing an important, valuable task.
Making it meaningful.
Exactly. It's critical to understand that human beings are motivated by various types of needs, from fundamental physiological needs to higher-level social recognition and self-actualization. Strong, intrinsic motivation is particularly needed for challenging, complex jobs, as easy or monotonous jobs can sometimes paradoxically lead to idleness or disengagement. Crucially, positive motivation, like genuine recognition, incentives, or rewards, generally has a much greater and more lasting impact than punishment or negative reinforcement. The surprising insight here is that motivation isn't just about money. It's often about purpose, autonomy, and mastery.
Then there's the nuanced challenge of delegation of authority. This is about empowering team members not just with tasks, but with the responsibility and freedom to make decisions.
Trusting the team.
Right. When authority is properly, thoughtfully delegated, it makes people feel more responsible towards their job, making them feel more engaged, valued, and perform more efficiently. A person inherently feels that if they have more autonomy and authority, their situation would be better and they would contribute more effectively.
Ownership.
Fostering a strong sense of ownership over their piece of the project. A common pitfall for project managers, especially those with technical backgrounds, is the temptation to micromanage, which stifles initiative and trust.
Group functioning is absolutely vital, especially when projects are large and complex, involving several departments, multiple organizations, or even global teams. Effective group functioning can be formal, with established hierarchies, or informal, based on relationships.
Formal versus informal groups.
Right. There are three general types of groups often seen in projects. Vertical groups, which are hierarchical, horizontal groups, which span different departments at the same level, and mixed groups, which combine elements of both. Generally, project managers try to build a mixed group because it is often more effective for complex project management.
Mixed groups, why?
Bringing together diverse perspectives, skills, and hierarchical insights. This raises an important question. What's the underlying psychology behind why mixed groups often outperform others in complex project settings? What makes that blend of vertical hierarchy and horizontal collaboration so powerful and resilient in the face of challenges?
That's a fascinating question. From a psychological perspective, mixed groups thrive because they inherently foster greater cognitive diversity. You get different ways of thinking, different problem-solving approaches,
More ideas?
the different perspectives on risks and opportunities coming from various levels and departments. The vertical element provides clarity, decision-making power, and resource access, while the horizontal element encourages cross-functional collaboration, breaking down silos, and fostering innovative solutions that might not emerge from a purely hierarchical structure.
Best of both worlds.
It's about combining efficiency with adaptability, making them far more robust.
And finally, a key aspect is direction. Project managers, who are often technical people or engineers, are responsible for clearly directing their subordinates on how they should perform their tasks, ensuring quality and adherence to specifications.
Setting the course.
They are responsible for the effective utilization of limited resources and for skillfully dealing with the inevitable human relation problems that arise. To achieve the project objectives, the project manager must also foster a strong managerial orientation among the people, helping them see the bigger picture, understand their role within it, and feel a shared responsibility for the project's success.
Guiding, not just telling.
Exactly. It's about more than just telling. It's about guiding and inspiring.
So it's clear that the softer skills of leadership, motivation, and team building are just as vital, if not more so, than the technical ones. They are the unseen forces that truly make or break project success, turning a mere plan into a living, breathing, successful endeavor.
Couldn't agree more.
Outro.
What a deep dive we've had into the dynamic world of project management. From truly understanding its core definitions and the unique characteristics that set projects apart, to navigating the rigorous phases of capital budgeting, diving into crucial market and technical analysis.
Financial viability. Securing financial viability and keeping everything on track with meticulous planning and control. It's a monumental undertaking.
And we wrapped it up by exploring advanced network techniques like CPM and PERT, the critical importance of ongoing project review for continuous improvement, and perhaps most importantly, the indispensable human facets that truly drive project success.
Right.
Because ultimately, knowledge is most valuable when it's not just acquired, but deeply understood and effectively applied.
It's truly fascinating how a seemingly straightforward field like project management is built on such complex, interwoven interdependencies, requiring a seamless blend of analytical rigor, meticulous planning, and profound human ingenuity.
It all has to work together.
You can really see how every single piece fits together, like a perfectly orchestrated symphony, for a successful outcome. It's never just about one thing. It's about how all the things work together. For you, our listener, here's a final thought to mull over as you go about your day. Consider a significant goal in your own life, perhaps a career change, a personal development endeavor, or even a major household renovation project. How can applying the project life cycle concept?
That start, growth, peak, decline.
Exactly. Thinking about its slow start, its growth, its peak, its eventual decline, and its clear termination. How can that fundamentally change your approach to planning and execution? Could understanding these natural phases help you anticipate challenges, allocate your personal resources more effectively, and truly celebrate milestones along the way?
Food for thought.
Definitely. That's all the time we have for this deep dive. Thank you for joining us on The Deep Dives, presented by Knowledge Flow. Until next time, keep digging for those insights.